I will spare no effort to turn this pandemic around once we're sworn in on January 20th. To get our kids back to school safely, our businesses growing, and our economy running at full speed again.
Welcome back to Quick Take Charge. I'm Tim Sinovac. With rising COVID case counts globally, nations are heading back into lockdown. A vaccine, even if it's approved, will take time to roll out, and the path to a stimulus deal in the U.S., well, it certainly seems uncertain. Does that mean a second recession is on the horizon? Joining me now is Bloomberg Markets reporter Sarah Ponsick. Sarah, great to see you this morning. I want to talk about this idea of a W-shaped recession, this idea of a double dip. Explain what it is, and does it look like we're on the path to that?
Right. So all year long, we have really been playing a game of economic recovery alphabet soup. So at first, the hope was for a V, basically an economic recovery and deep dive that would be very quick down and then also sharp on the upside. Then the next letter that we went to was K, the idea that everyone went down at the same time, but the recovery was very lopsided. So you had half of the economy doing well, moving higher. Meanwhile, a lot of services areas of the economy were still headed lower. So that's the lower leg of the K. Now we're talking about W. I actually had an email from an economist hit my inbox this morning saying this looks like a W-shaped recovery. Now what that means is that think of your V if you were down up, but add in another V. So down up again, which means we would be on that second leg down. The idea that if we have rising COVID cases, even if you don't see strict restrictions put in place or mandated lockdowns, the idea that consumers, people might get a little bit nervous from the rising case counts. Just this morning, we saw that we had record hospitalizations in the U.S., so people might self-govern, self-police, and therefore you see economic activity slow down once again, and you get another dip, so you get your double dip there.
So explain the disconnect. I mean, we know that the stock market is not the economy. We know that the two are connected in some ways, though, and the signal that we're getting from investors right now is that it's time to rally.
Right. So right now, if we look at the S&P 500, it's on the cusp of a new record high. This, as we are talking about the potential for a double dip recovery. So all year long, really what the communication, the narrative has been was that the stock market is very much heavily weighted towards technology stocks. Some of these companies did not just get away with not getting hit by COVID-19. Some of them truly benefited and made more money because people were stuck at home working. You think of Amazon, for example, with getting deliveries at home, or Microsoft, especially in their cloud business with people working from home, kids schooling from home too. So that's really been the story all year long. Now, this latest push, though, has been different. Ever since we got the Pfizer news, the contours, the makeup of the stock market headed higher has been a bit different. We see a little bit of a pause today with tech once again bouncing back. But this, as we've seen, cruise lines, airlines, all starting to head back too, smaller companies. So the hope is that you can continue to see the stock market head higher, but no longer be dragged higher by just a couple heavily concentrated names. You really need to see more participation here.
Where does politics come into this? Because just yesterday we learned of another result, this one in North Carolina. Incumbent Senator Tom Tillis winning the election there, looking like that it is increasingly likely the Republicans will hold on to the Senate. Of course, there is a wild card in January in Georgia. What should investors expect over the next couple of months if President Trump continues to sort of hold on to this? I mean, I don't even know what to call it or even entertain it. If he doesn't admit defeat at this point.
Contested election, yeah. We'll make it politically correct.
I imagine it could get a little ugly, but let's not even go there. What are the markets telling us about how they could react to that?
So on the Senate side, whereas, yes, it's possible we could still see that blue sweep, that blue wave Democrats taking control, it does seem like Wall Street has really come to terms with the idea that we are going to have gridlock, which they are completely fine with, considering the rally that we have seen in the stock market since Election Day. Now, if we were to see that, odds are relatively low. It's unclear how the markets would feel, but remember that heading into the election, this was the outcome that investors said they wanted. So the idea is that maybe they wouldn't have a problem either which way. Now, President Trump, what he would have to do with the stock market over the next couple of months. I've spoken with some investors who think that this is a true risk to the market, the idea that he's been so unpredictable over the last 4 years. Well, maybe he will ratchet that up even more over the coming months. You'll have firings, cabinet reshufflings, also potentially some executive orders. If any of that hit on the trade front, hit with China, that could be something that could impact markets.
Wow. It's exhausting.
Yes.
That's what it is.
To say the least.
Sarah Ponsick, thank you so much for your time.
The biggest stories the moment they happen from around the globe. Subscribe to Bloomberg Quick Take now for insight in an instant.